Welcome to today's Corporate Venturing Insider series. Today we are going to have an expert in private equity, but that's going to share some opinions about how we should think about investments. Gustavo Schwed is from NYU Stern. I'm going to call you Gus. You already allowed me to do that. So, Gus, welcome to the podcast.
Thank you. Nice to be here.
Thank you. Gus, do you mind sharing a little about your journey and especially around investments, private equity? You've done a lot, including fundraising, and I think it was the biggest LBO in European history. So I think you have a lot of things you could share, but I really want you to go from maybe early to today.
Yes, happy to do that. And I have to say that my trajectory has not been a very straightforward trajectory. I started at a liberal arts college, getting my undergraduate degree, a place called Swarthmore College, which is a classic small liberal arts school. I was an economics major, but there was no courses offered in business and accounting and finance and any of those things. When I got to be a senior, I started thinking about what to do with my life. I happen to have had a friend who would spend a summer working for an investment bank called Donaldson, Lufkin and Jenrette, which is no longer around, but was a very successful investment bank back then. And basically, he made me aware of the existence of these banks, and I started applying to them. I got a job at DLJ. And honestly, when I got that job, I was not 100% sure what DLJ actually did. But I knew that it was a job that attracted a lot of people that are focused on success and achievement. So it caught my interest. I also knew that quantitative skills were important in that job, and that was a strength of mine. So just based on that, it seemed like a decent fit. So I went and became an analyst at DLJ for the standard 2-year program. This is back in 1984. It's hard to imagine that even back then we had these programs, but it was very much like it is today. You spend 2 years there working around the clock. I did a lot of M&A work as an analyst back then. And after 2 years, I was pretty much fed up, I have to say, not because the work wasn't interesting, but because I think the lifestyle was unsustainable. It was just really working around the clock, and there was virtually no regard to sort of my time and my life outside of work and so forth. And it just didn't seem like a good fit to me. I went to business school. I went to Stanford Business School. And while I was there, of course, I was exposed to the buy side because Stanford is in the middle of Silicon Valley and in the middle of the venture capital community. 3000 Sand Hill Road is a 10-minute drive. And so that was already a very well-established community. And I just thought, look, this is a way for me to apply some of the same skills that I picked up at DLJ, but do it in a way that fits my objectives better. And those objectives were partly quality of life, but also deeper thinking about the companies rather than just the minimum amount of thinking required to put a sell side proposal together. That appealed to me. It was very difficult to get a job in venture capital, as it still is. But I just leveraged my connections at DLJ to get a job at the Sprout Group, which was DLJ's venture capital unit. So it was a corporate venture capital group in a sense, although it was affiliated with an investment bank, not with a tech company. And Sprout was already a long-standing franchise that had a lot of success. It was very well run, had a very thorough investment process. I really learned how to think like an investor at Sprout. I really learned how to identify risks, how to balance risks against upsides. So it's very easy to identify a risk and then get so bogged down with the risk that you actually never do anything. So you have to be able to balance the two. And I also learned the hard way the pain and agony that comes from making a bad investment. So I developed, good skepticism, I guess, through that experience. And I did that for 6 years. I started investing in medical device companies. not because I had a medical or even a science background. It's simply because there was a gap in coverage at the firm.
Mm,
Seemed like a place where I could make my, my own deals. And I did that. That's where the liberal arts education is actually very helpful. Being able to enter into this VC world, not know anything about medical products, and just learn it. And learn it to a point where I was quite proficient, where, I spent a lot of time speaking to physicians in terms of diligencing products and technologies. And I found myself at times explaining to them the technology that I was diligencing because I'd spent so much time on it. So I did that for a while, like I said, for 6 years. I did feel after a while that my world was becoming pretty small. The world of medical devices, it's not a huge industry. And I just wasn't entirely comfortable with this idea of specializing so deeply so early in my career. It's like,
mm,
at that age, how could I possibly know that this was the right place for me? And coincidentally, a very senior person at DLJ approached me at that time, knowing that I was born in Argentina and that I spoke Spanish, and asked, whether I would join his merchant banking fund. That's what we used to call private equity. DLJ had a $1 billion private equity fund. At the time, this was in the early 90s, it was one of the largest in the world, actually. And he wanted me to join them and start a Latin American private equity business, which was very appealing to me because I just thought it sounded like fun to invest abroad and to interact with people in different countries and different cultures. I thought I'd have a competitive advantage because of my upbringing. So I was born in Argentina, but until I was 14, I lived in 5 different Latin American countries. So I knew that culturally it was very comfortable with that part of the world. And it was also an opportunity at a fairly young age. I was in my early 30s to start a private equity business within this fund. So I did that. And a number of things happened that the kind of things that happen at companies where things get restructured, somebody gets brought in, jobs get changed, et cetera, et cetera. And I found myself going from having responsibility to build this effort to now being asked to report to somebody. And I was unhappy about that. Perhaps that was a bit immature on my part, but I was unhappy about it. And so I ended up joining Morgan Stanley to do the same thing. The guy that was running Morgan Stanley private equity back then, this was now in the mid 90s, was enthusiastic. He wanted to create a global business. And so he wanted to add Latin America to that global business. And he asked me to do that for him, which I did. So I got started with Morgan Stanley, and I moved to Brazil because the traveling from New York to South America every other week was unsustainable. So I
mm,
moved to Brazil, moved my whole family to Sao Paulo, relocated, and started building that business for Morgan Stanley in Latin America. And that took me till the year 2000. And what happened in Latin America in the late 90s, it was essentially a complete collapse because the strong currency regimes that Argentina and Brazil had introduced to try to bolster their currency became unsustainable. Basically, you started running out of control fiscal deficits, a lot of pressure on the currency. The US dollar reserves were fleeing the country. And that eventually forced them to unpeg the currency from the dollar, and the currencies collapsed. And as a result, that destroyed a lot of businesses.
mm,
And honestly, at that point, this is now the year 2000, I was pretty sure I'd get fired. It just seemed logical to me that, here I was running a business that ran into this wall. And even though you could argue it wasn't my fault, it was sort of macro factors.
yep.
People in that situation tend to get fired anyway. But my boss, who I think, I had a very good relationship with, and he thought highly of me, instead did call me and said he'd like me to shut down this Latin American effort. And he offered me the choice of coming to New York, joining the group in New York, or going to London and joining the group in London. And again, I made a decision based on what was less covered. So New York, lots of partners in New York, not that many in London. So I chose to move my family to London, join Morgan Stanley Private Equity London. became a partner and became the co-head of the European private equity business. So that was my big sort of bump up, I guess, and my first real exposure to larger leverage buyouts, which was what Morgan Stanley Private Equity was doing. And I was happy there, working at Morgan Stanley Private Equity, and like I said, co-head of Europe. And by the way, at the same time, I was expected to keep running the emerging markets private equity business, which no longer included Latin America, but we had people in Hong Kong and in Singapore. And I became chairman of Morgan Stanley's emerging markets private equity business. So I wasn't active on the deal side, but I was sort of supervising the people who were. So I had this dual mandate, and that was all fine until I'd say 2004, when the CEO of Morgan Stanley decided that the conflict between the buy side and the sell side was unsustainable at Morgan Stanley. In other words, every time that I had a deal I was interested in doing, I had to go through a conflict check. And every time I went through a conflict check, there was some investment banker who said, you can't do this deal because I want to represent a buyer, or I want to represent the seller, or something like that. And of course, it was an adjudication process for these conflicts. But because the probability of success in an investment banking mandate is always higher than the probability of you actually being the successful buyer in an auction environment, the bank more often decided in favor of the investment bankers. And I really felt like I was doing private equity with a hand tied behind my back.
Yep.
But then the CEO said, we don't want these sort of conflicts, so we're going to shut down private equity. We're not going to be in that business anymore. It's a decision that's since been reversed, by the way. But at the time, they made that decision, and so I found myself on the verge of being unemployed, and I started looking for a job and found a job at Providence Equity Partners, which is a global private equity firm. These days, I think they have about $50 billion of assets under management. And what's interesting about them is that they have a fairly narrow focus in terms of industry. It's telecommunications, media, education, information services. Those are the areas that are covered, and those areas themselves connect to each other in some ways. So it's quite specialized. I joined them as a partner in London, where I was already living, and looked for leveraged buyouts in Europe. And it was quite refreshing to work for a private equity firm that was unaffiliated with an investment bank. I felt like I had more degrees of freedom. So I went off and pursued deals. I focused more than anything on telecommunications. And one of the deals that I did was the TDC deal, which is the telecom incumbent in Denmark. I was quite interested in buying a telephone company because they had a history of being state-owned monopolies. They weren't at that point, but that was their legacy. And so they were quite inefficiently run. And I thought there was opportunity really to create value in all of them. But most of them were too large for private equity. You can't really buy Deutsche Telekom if you're in private equity. It's just too big.
Yep.
If there were a handful that were small enough that conceivably you could do it, it was kind of untested. The only two deals that had been done in the industry, one was Aircom, the Irish telephone company, which Providence had actually done, but that was a much smaller business. And then Bezeq in Israel, which Apex had done, and that was also a much smaller business. So TDC, I teamed together with KKR, with Blackstone, with Permira and Apex. So it was a group of 5 private equity firms to buy this business. It was too large for any one of us. And this is before it was the private equity world shifted from club deals to co-investment, the co-investment model, which is how you fill deals that are too large for a single investor these days. So we bought TDC. That was the largest LBO in European history. It was about a $15 billion deal. Since then, obviously, there's been larger deals. But it was a kind of a groundbreaking deal because it took on a company that was of intense public interest. So the Danish political establishment, media establishment, and even general population was very focused on this deal. And they had, of course, a strong bias against the private equity industry. They considered us to be vultures. And they thought we'd just go in there and break it up, you know, suck out all the value, leave the carcass behind, etc. So that was basically the narrative that was created by the Danish media. And honestly, I think we did not do a very good job of countering that narrative with our own narrative. We just
Mm.
kind of felt that the less we said, the better. And I've since learned that that's really not true. But
Yeah.
that deal was successful. That deal was done just before the financial crisis and was exited just after the financial crisis. So it was one of the few successes during that period of time. It's not shocking that it's a success because it's a subscription business that provides a vital service.
Mm.
So it's pretty recession resistant, which is frankly one of the things that appealed to me about it. We did cut costs very significantly. And even in a highly unionized environment and with very strong labor laws, we were able to do that with not very much pushback. We had some pushback, but not very much. You know, we were obviously very careful to abide by labor laws. I think on average, people were getting 2 years worth of severance. And we respected the unions in terms of the order in which people reductions in force would take place, et cetera. But we did what had to be done. And it has to be said that despite cutting about 40% of the workforce, revenue did not decline. So the productivity of each worker increased significantly during that time. Revenue also didn't grow, but that's because the markets were melting. So the biggest market was the landline market, back in the day where people had phones that were connected to something. And those were dropping at a rate of 10% a year. We were experiencing fixed to mobile substitution. So people were dropping their landlines, getting mobile phones, but the substitution was not very beneficial because the margins were higher in the landlines than in the mobile phones. Mobile phone, the architecture of that industry was much more competitive. We had 5 players, whereas we're a virtual monopoly in the landlines. And also, so we were basically trading high margin dollars for low margin dollars, and that was a constant headwind during the entire process. A lot of management changes, lots of reductions in force, but also some innovation. We introduced, first of all, we upgraded the cable network to be fully digital network. We introduced all sorts of services that are ubiquitous now, but a streaming service, a video streaming service, a music streaming service, services that we give for free as retention tools. So as long as you continue to be a customer, you could get these services for free, and you stop being a customer, you lose the service and your playlists and all that stuff. So we really tried to, as growth was really not in the cards, we tried to focus on retention. At the same time, TDC had all these non-core businesses all over Europe that it was managing very poorly, and honestly just didn't have the management capabilities to keep track of them. So we sold all of them, and we used the proceeds to pay down the debt. And at the end, we took the company public, and we made a modestly good return. I wouldn't say it was spectacular, but I really think we left that company quite a bit stronger than it was when we got there, despite all the noise that went around that strategy. And then I did some other deals while I was there. And I kept working at Providence, London, until 2012, when I simply retired. I just decided 25 years in private equity, you know, it's been a good career, but I just want to see other things, just like I
It's like
decided.
50 years in a normal company.
Sorry?
It's like 50 years in a normal company.
Yeah, perhaps. Yeah. It was a little bit the same decision I made to leave venture capital. I just, after a while, and honestly, the private equity industry, which when I first joined, was just so intellectually stimulating. You spent so much time thinking about companies and value creation, all that. And by the time I left, the work, day-to-day work, had become so much oriented around project management. You know, participating in a buy-side auction means you have to follow a set of rules. You have to hire a set of advisors and manage them. And a lot of it is just managing the process. It crowds out a lot of the deep thinking that needs to go in terms of evaluating an investment. So anyway, I more or less, the thing had more or less been played out for me. And I decided to retire. And honestly, I retired with no notion of what I would do next. The only other activity I had then, which I still have, is I was on the board of my college, Swarthmore College, and I was on the investment committee where we managed the endowment. And Swarthmore is a tiny school with a fairly large endowment. These days, I think we have about 800 million in private equity and venture capital. And so I led the part of the investment committee that evaluated and allocated capital to VC and private equity managers. And I'm still doing that. I'm still involved in that. So I'm still very much connected to what's happening in those worlds. But after about a year of not doing much, I was invited to do a guest lecture at NYU Stern by a professor who teaches a course in hedge funds. I just spoke about private equity. And based on that, they asked me to put a syllabus together. Then they asked me to teach a course as an adjunct professor, which means that you don't actually have a job there, but you get paid per course. And after about a year, given the popularity of the course and also the fact that they really did need coursework in private equity, they asked me to join full time. That would have been in 2014. And I've been teaching there full time since then. And my courses, I mostly teach a course in private equity, which is really broadening to more into private capital. And I, for some years, taught a simulation course where I simulated a deal and I split the students into teams. That became so labor intensive that I decided to drop that. But at the same time, I teach a course every spring. I co-teach it at Princeton University, and that's a course that combines entrepreneurial finance and private equity. So today I teach 3 courses. I teach a MBA level course in private equity, an undergraduate level course at NYU in private equity, and an undergraduate level course in entrepreneurial finance and private equity at Princeton.
Wow, this is quite the journey, and I like the fact that now you're teaching and helping students to think about how to become investors, which is part of what the podcast here is supposed to do. I want to ask a question about liberal art because you make a point about that was important for someone who doesn't have PhD or a technical background to actually think the right way and to be good at learning. Could you double click on the value of the liberal art because we do have quite some audience who are not technical going into technology.
Right. Well, I'm a big believer in the liberal arts. I was educated that way, and I'm on the board of a college that is a leading liberal arts college. The idea behind liberal arts, for those who might not be familiar, is rather than going to college or university and specializing very narrowly in something that has sort of a vocational angle, you go to college and you take coursework in a variety of different areas. And honestly, a lot of the coursework is completely unrelated to jobs. So you do have a major, but out of the 32 courses you take, only 8 need to be in your major. So you have 24 courses you can take in other things. And we do have an engineering program at Swarthmore, but the engineers, again, they take tons of courses in other areas. And by doing that, you start strengthening really important skills. One is the critical thinking skills, which are applied to every course. It doesn't matter what topic it is. Secondly, communication skills. By that, I mean writing and speaking, both of which are really stressed at these liberal arts programs. And whereas, I could have gone and gotten a finance degree, say at Wharton, and that would have been very, very useful to me in my first job. In fact, I would have known what DLJ did had I done that. And by the way, DLJ, until I arrived, hired almost only Wharton grads because they wanted people who could hit the ground running. So what I found when I first got to DLJ was I was definitely at a disadvantage against other analysts at the time. But within 6 months, I was at the very top of the class and had surpassed most of them. And I attribute a lot of that to already being conditioned to going into an area that is unfamiliar and figuring out very quickly how to break it down and how to get to the bottom of it and how to understand it. And so then I applied it again when I started my job in venture capital. I was never intimidated by going to a new area. In fact, students ask me all the time about what they should specialize in. And I tell them, well, specialize in what you like, but don't worry too much about it because it's possible that you'll change that several times during your career. And it's not that difficult. It just takes some concentrated effort for some period of time. And then you can develop domain expertise, which I did over and over. So I mentioned the DLJ experience and the Sprout experience in medical devices. But then I went to Latin America where, I didn't know the business community at all and I had to be a generalist. You can't really be a specialist in a small market. And then I went to Europe and there I had no context whatsoever in terms of culture. And I started looking at telecom deals, which I hadn't looked at before. So I attribute a lot of that to liberal arts education.
It's amazing, and it's a golden nugget, I think, for everyone who's thinking early about their career, not to plan too much. And actually, you preempted my questions because there are so many examples in your career where you went where you didn't know what it was going to look like, and you use words like going where it was a less covered choice, it was untested, uh, early 30s, starting a fund. You never did a fund before. So I think there is an how do you get the courage? Because there's a level of courage to be able to go for something you have never done before, including in a new country you've never lived in before.
Yeah. Well, it never felt like courage to me when I was doing it. It felt like the right business decision or the right career decision. And by the way, it turned out not to always be the right career decision. So the Latin America experience, while it was a tremendous growth experience for me, in a sense, it was a failure because the entire region collapsed. But to me, these decisions were motivated more by what stimulated my interest, where I thought I could be good. And I guess I was just never intimidated by those changes. I've lived in 7 countries, so I'm used to being dropped in new environments and
Mhm.
adapting very quickly. So for somebody maybe who's grown up in the U.S. Their entire life, maybe even in the same town their entire life, going to work in another country is really an intimidating prospect. For me, it never really was. I went to live in Brazil. I learned Portuguese and I conducted business in Portuguese. To me, it just seemed like the natural thing to do. What I do tell my students come to me for advice all the time, is the broader your view, the more effective you are going to be in the deal business. In other
Mhm.
words, if you have a very narrow view of the world, if you only think about the things that are of immediate interest to you or that you think are directly linked to career success, then you're going to develop tunnel vision and you're going to be less effective with other people. You're going to have lower emotional intelligence. You won't be able to sense as easily how emotions play a part in complex situations, or even to read other people as well. So what I tell them is one of the best growth experience you can have is go live abroad for some period of time, even if it's just a couple of years. It'll teach you, if you don't already know, that people in different countries often have different ways of thinking about things that are in some ways better, in some ways worse. But they're just basically just different. And and so understanding that is really important in the investment business. So yeah, I really encourage young people to spend some time abroad, and also to put themselves in uncomfortable situations. That's really where growth really takes place. So, I'm naturally not a very extroverted person. I'm not naturally a person who enjoys going out there and doing a lot of networking and glad handing and all that stuff. But as soon as I got to Sprout, my first job, it took me no time to realize that was critical to career success. And I just forced myself to do it. I forced myself to do it. I would, if I had nothing to do, I would just look around and find some medical conference somewhere and fly out there and just spend 2 or 3 days. And sometimes I come back and I'd say, well, that was a waste of time. Other times I just learned something that, really surprising and really useful. Um, but over time, I just sort of developed this habit of every time I sensed resistance from my own self doing something, I try to push through it because I knew that the right thing to do was to make myself uncomfortable and to grow. And then over time, you realize that things generally aren't as bad as you expect them to be. From experience, you learn that.
Which also gives you confidence to go to the next big challenge. And I would argue, you said it was a bad decision to go to Brazil, but I think it was a good decision, bad outcome type of profile.
Perhaps.
And I like the way you frame it, which is don't be afraid to go into the uncomfortable. I like the fact you mentioned about being more of an introvert, and yet you understand it's critical to go and network, and that's really good. You also talked about the agony, that's the word you use, for bad investment. And talk about being uncomfortable, but here it's with your own actions, the consequence of your own actions. So can you share a bit more for the investors who are listening, how you handled that agony and how it made you a better investors moving forward?
Yes. Well, it's agony because it sucks up all your time and energy in a very negative way. And honestly, when an investment goes bad, my experience is it's really very difficult to turn it around. So you end up
Mm.
spending a lot of time and energy on it. And most of the time, that doesn't yield the results that you want it to yield. So I think actually what's very important is to see the inflection very early, because by the time the investment's distressed, it might be too late. So, yeah, it's agony to have to go in there and, fire a bunch of people and have very ugly confrontational disputes with the CEO. And perhaps, the CEO doesn't like how they're getting fired and they threaten litigation. And there's a lot of bad things that come out, and it's emotionally very taxing. Um, uh, but of course, if you do your job, you have to try. You have to try to go in there and turn things around. And the critical thing is to learn what went wrong and try to avoid it in the future. It's usually things that I find that things that I've learned are, first of all, um, the management team. Management teams often, or let's talk about CEOs.
Mm.
If I were to do a Venn diagram where every CEO is a bubble, I think the area of greatest overlap would be communication skills, because these are people who have to sell a vision internally and externally. But that also makes them very dangerous because they're very skilled at communicating. And I've learned the hard way how important it is to break through the facade and to really understand what makes this person tick, what they're good at and what they're not good at. And, these are people who could be terrific visionary entrepreneurs, but when the company reaches a certain level of maturity and you should manage through use of key performance indicators and numbers and monitor cash flow and stuff like that, these people often can't make the transition or they're not interested in it. So that's an insight that's important too. It's don't get too impressed by the person's entrepreneurial success if you're thinking about backing them in something that's not strictly entrepreneurial. So that's an important lesson. The other is don't be intellectually dishonest with yourself, because it's very natural to feel a little bit of deal fever. You've been working on a deal, you want to close it. When you close a deal, you get pat on the back for closing a deal. But of course, it's a provisional patting on the back, because what
Mm.
really matters is what happens with the deal later. And so there's a saying about, what is it? It's act in haste and repent at leisure. That's what doing a bad deal is. You act in haste with the excitement of doing a deal, the momentum, the desire to make your mark. And then you can spend the next 5 years suffering as a result of the bad decisions you made. So don't ignore the warning signs. Don't rationalize them away. And be very, very mindful of the CEO, because nobody has more influence on the success or failure of a deal than they do. And when you're looking at, one thing that you learn from doing bad deals is to be, very, very careful when you look at future deals. It's not a numbers game, in my opinion. I know some people have made success. And actually, I know that early stage VC is kind of a numbers game. But
Because of the power law.
yeah, exactly. But
Yeah.
in private equity, it's not a numbers game.
No.
And you have to be super selective, and you can't just say, look, I'll just do 10 and 2 of them will be good. And that's fine. It doesn't work that way. So you have to be very skeptical, very skeptical. You can't be so skeptical that you become cynical. If you're a cynic, then you're only good at seeing everything as can go bad, and then you'll never do a deal and you're not creating any value. So managing the balance between skepticism and optimism, that's tricky too, but you have to maintain both.
It's very challenging because you have to see everything that could go wrong with open mind and open eyes, but you have to look at how big it could become if everything goes right. And this is typically not the same person's natural tendency, right?
That's right. Yeah, that's right.
I like the way you framed the don't be intellectually dishonest with yourself. And I think it touched on a point I think called sunk cost. You spend so much time on it, you want to believe it, you want to close it, you know you're going to get a little positive rush from the team that you're closing. But it's very hard for people, despite that sunk cost, to see all the yellow and maybe red flags. How would you advise someone who's about to make their first big investment? You can see they spend so much time on it. They are invested in it. They believe in the management team, the storytelling from the CEO. But there are some yellow and red flags. How do you make sure that they see it and they are intellectually honest with themselves?
They have to be able to articulate to themselves and to an investment committee. First of all, they have to be very, very honest about the risks with themselves first, but also with an investment committee. It's a very bad idea to manipulate an investment committee. You have to be brutally honest about the risks, and then you have to be able to articulate to yourself and to them why, despite the risks, you want to do the deal. I think that's a good discipline to order it that way.
I want to double click on this because I think that's so important not to be dishonest, but also not to spin towards an investment committee. So when we make an investment proposal to our investment committee, we get a lot of quotes from TDK teams, our mothership, from investors, from big companies, and we put them all in. The negatives, the positives, the neutral, we don't try to spin anything and hand select. Can you share why you think, and I think it's both short term but long term, but why it's so important the investment committee gets to see the deal as it is?
Well, for the most obvious reason is it leads to good decision making, right? If you're somehow manipulating, or as you said, spinning the information that you show an investment committee, but the deal may get approved for the wrong reason. And secondly, if the deal goes bad, then it's very different if your investment committee was fully supportive to begin with than if they were supportive only because you manipulated the information. It's hard for an investment committee to blame you for a deal that goes bad for reasons that were disclosed as actual risks in the deal, because all of you together made the decision to move forward.
Yeah.
So I think it's good even to protect your own career, to be that honest. It does require a level of trust. Not all investment committees are good investment committees. Some of them are populated by other partners who are envious of your success. So they might see you propose a deal and they say, gee, if this person gets this deal done, they're going to look good relative to me because I haven't done a deal in a year, say. And so investment committees themselves don't always completely work in good faith. And that's something for whomever is leading the investment committee to manage very carefully. There's a two-way street. The person pitching the deal has to be brutally honest, and the people in the investment committee have to assess things at face value and not bring their own, fears and concerns that have to do with their own career into the discussion.
Yeah. I remember the first decline we received from the investment committee. We were extremely neutral, showing all the risks. It was declined, and I believe for the right reasons. And when we did the debrief with the investment director, I said, well done, because you got the IC to the right place and they made the decision with what you presented well. And I always worry when people say, we are going to pitch this deal to the IC. And I feel like if you say pitch, you're already in the wrong framework. It should be presenting what we know and what we don't know.
I will say this, though, just to add a little nuance to this. It's also true that if you simply go to an investment committee and present them with a bunch of facts and don't take a position, then it's understandable the investment committee says no. Because if you're simply telling the investment committee, here's a bunch of somewhat contradictory findings, some are point to the downside, some point to the upside, you decide. You synthesize and you decide. They're going to say no. They want to hear that you've done the synthesis.
Yep.
And that you, notwithstanding all these appropriately disclose risks still think that you want to move forward, right? They have to feel that.
Yeah. Yeah. I agree. You have to show your conviction why you believe it makes sense, despite all the risk and all the things that can go wrong, because risk adjusted valuation, it does make sense.
Indeed.
Very nice. Now, so we talked about the challenge in Brazil, the total currency collapse, moving to London. And then you mentioned something about time for deep thinking. And it's very hard when it's all crashing around you to have deep thinking. But can you share about the value of deep thinking and how to maintain it when it's challenging?
Well, I mean, a a deal, a private capital deal, be it venture capital, private equity, or whatever, it's a very complex situation. You're talking about a company with a lot of people involved, and people are always complex, and facing a number of challenges, risks and upsides. And then there's behavior outside of the company, competitive behavior, what's happening in the markets, what's happening in economies. There's just a lot of factors that can affect the success or failure of a deal. And there's a lot of ambiguity. And the best you can do is really think very hard about what is, you know, how do you think this company can get ahead? How do you think they can make money? How do you think they can grow? How do you think they can create value? Understanding the full sort of environment in which it operates, including its own people, the outside environment, et cetera. And I know some people rely on their gut when, and I don't want to minimize the importance of that. Some people have very good commercial instincts, but I always found that only by thinking and reviewing and studying and all that stuff did I gain enough of a detailed, nuanced view of the business that I could take an investment position. Otherwise, the stuff you learn in the first go around turns out to be quite superficial, I find. So, you might do a little reading, spend a little time with the company, and you think that, okay, this is a player that's gaining market share in a growing market, et cetera, et cetera. But to me, it requires iterative thinking to really get deeper and deeper and deeper until you feel like I really understand this, I think, about as well as I can. Because there's no guarantee that that's going to create a good deal because there's so many things you can't control. But I think it's the best you can do.
Could you make the argument that a stronger discipline, deeper research is what will allow you to see something special where others would not have seen it because they wouldn't have researched the same way?
Yeah, I think so. Not only can it help you select things that make sense, and let's face it, particularly in venture capital, there's a lot of following the leader type behavior, right? You have a bunch of the top firms do investment in a certain area, and all of a sudden everybody wants to do the same thing, and discipline degrades very quickly. So I do think it helps select the right investment, but I also think it helps manage the company afterwards. So there's nothing less helpful to a CEO than a private equity person who joins their board with a very superficial knowledge of the business and starts prescribing solutions, right? You're not being helpful there. To put together a value creation plan, to help a CEO execute a value creation plan, you've got to know the business really, really well. So all of that, I think, pays off. But you did bring up a good point before, which is you're trying to do this while trying to execute a deal. And that, this gets back to this project management that happens so much now. Project management is time consuming, but it's not that it doesn't require a lot of thinking, but it kind of crowds out your time, the time that you have to really consider deals. And I think it leads to more lemming-like behavior, more people just doing the same sort of thing. And so that's a bit of a problem. The private equity industry has become a little more like the M&A industry in that, they're very focused on doing deals, and maybe relative to 20 or 30 years ago, less focused on the quality of what they're buying.
Now, I want to actually double click on the time management, because earlier on, when you mentioned the first 2 years as an analyst and they were sucking the time out of you and all your energy, and that was not for you. Then you move to the next place where it was for quality of life to some extent. There is a lot of discussions about work-life balance, and I think everyone could have their own opinion, but time management is a key element to success, no matter what. What's your hindsights from everything you've learned about how to manage your time well, and what are the mistakes maybe you've made in the past you wouldn't do again?
Yes. Well, one thing I learned is that you can improve your time management. In my early days, I think I was essentially addicted to being in the office. In other words, I felt like the expectation that I would be working all the time was so strong that even when I didn't have things to do, I felt guilty about leaving the office.
Hmm.
So that's an irrational behavior that should be eradicated, right? Because if you get out of the office during those times when you don't have stuff to do, nobody loses. Your employer does not lose, and you win.
Yep.
So uh, having, I guess I'll call it courage, the courage to, when you're not, you know, taking the time, when you don't have a pile of stuff to do, to rest and restore. I think that's important. And by the way, a fresh mind is always better when evaluating an investment than a tired mind. So that's one thing. The other thing has to do with managing anxiety. Uh, and, I've gone through periods in my life, particularly when I was younger, where I couldn't leave work behind because of anxiety. So I'd get home and I was still thinking and thinking, turning things over in my head in an unproductive way. In other words, I wasn't coming up with solutions. I was just turning it over and turning it over and turning it over.
Yep.
And then I'd go to sleep and still my mind churning and churning. And I guess, I don't know if I had an epiphany, but over time, it just became clear to me that that kind of churning is also wasteful, that nothing good comes out of it. If you're thinking about something because you're trying to come up with a resolution, then you can get as far as is productive, write it down so you feel closure, and then stop thinking about it. So one way to reclaim a measure of work-life balance is when you're not in the office, disengage so that you have uh, something other than work in your life. And that becomes especially important when you have a family. It's very unfair to them if, the few hours that you're not in the office, you're still keeping them at arm's distance because your mind can't let go.
It's a really nice golden nugget here. I want to talk to something that will be a challenge for anyone investing. And you talked about controlling the narrative and something you didn't do as much as you wish you had done. And there will be many times where we invest and something goes wrong, and people will take the spotlight to tell their own narratives. What did you learn from your experience in these investments you made, where all the Dutch may have had these narratives about private equity? What would you have done differently, and how would you think about controlling the narrative in a way that doesn't look like you're defending yourself, but you're putting forward the right positive narrative?
Right. So the deal that I was talking about, TDC, the Danish deal,
Oh, Danish, sorry.
the press was very negative throughout, and my view and the view of my co-investors was the less we say, the better. That anything we say, they're just going to attack, and maybe we should just stay quiet. And we had a PR consultant who kept calling us saying, "Why don't you let me do my job?" I never quite understood what he meant by that. It's like, well, what do you mean? You're our consultant. We consult you about, what's happening in the press. And so what I learned from that is whether directly or on background, you've got to be feeding the press with your version of the story. And it doesn't have to be defensive. It, in fact, can be maybe at TDC, we should have said, look at all the great things that are happening at TDC and just keep pushing them, keep pushing that. And it's true that there's a substantial part of the population that would never accept that, but it can influence the way people think about things. And these narratives aren't just a way to, I guess, to enhance your reputation. They have real direct impact on deal success. So you take a TDC, which is consumer business.
Mm.
If people wake up in the morning and read in the newspapers how private equity is destroying TDC, at some point they're going to start canceling subscriptions and going with a competitor. They don't like the brand. They just don't like the image that the brand conjures. And people have to feel good about the products they're consuming. So uh, it's not just a matter of, well, I'm tired of people saying bad things about private equity. It's also a matter of, well, people need to understand that we're not doing bad things here. We're actually helping the company, and we do care about our customers, et cetera, et cetera. So very important.
Yeah. In a way, controlling the narrative from the company point of view, not from the investor's point of view.
Yeah, I guess that's right. There was always an element of, we also wanted to improve the image of private equity um, in Europe, uh, which was a bit of a uh, impossible task, I guess. But part of the feeding the press is that as well, because otherwise there can be a political reaction against private equity. If the press convinces the voters that private equity is bad, the voters put pressure on the politicians. That leads to adverse legislation. So all of these are lessons that I learned throughout my life. I started when private equity was so small that nobody was really paying attention to it. And so we were very secretive. We thought, well, if we don't have to share what we're doing, why share what we're doing? And I guess I kind of missed a transition to when private equity became so large that it became something of public interest. And therefore it had to behave in a way that acknowledged that addressed the public concerns about the industry.
Yeah, you're becoming a very public stakeholder in the conversation. I want to shift gear and talk about your role as an investment committee for endowment fund. This is clearly a big responsibility, and you've had experience from early stage and very late stage type of investment. What recommendations would you give to someone thinking about joining the investment committee of an endowment fund? Yeah, what best practices would you suggest for them to follow?
Um, well, the first thing is you have to realize that your duty is entirely to the endowment and the college. So no conflicts of interest. If you are on this investment board and you shouldn't be recommending the fund that you're working things like that, right? The second is, I think trying to be too clever is a problem. So timing the market, saying, "Oh, I think that equities are in for a tough period for the next 10 years, so we're going to shift away from equities to credit, say, or something like that." I think a much better way to manage an endowment is to have sort of semi-flexible allocations to different asset classes. So ranges, say private capital, 25 to 35% or something. You need to give yourself flexibility, but then stick with that. And don't try to guess what's going to happen next. Because the world's too complicated. And I think people's predictive powers are actually pretty poor. So the major shifts should be about rebalancing, not about making big re-engineering sort of the asset allocation in a fundamental way. I mean, there's times when you may have to do that, like when Yale started investing strongly in venture and private capital. They were the first to do that. That was an excellent decision, followed by everybody else. But in a steady state mode, I think it's really managing those asset allocations, rebalancing, and trying to pick the best managers you can possibly pick among those the selections. So I would also say that if so our endowment is just short of $3 billion, which is not a very large endowment. It's very large for the size of the college, but it just means that when we pick a venture capital investment or a private equity investment, we're limited to how much we can invest, and therefore we have no need to go for the mega funds. So I can understand why Adia would want to invest in a mega fund because they have so much money, they need to invest in scale.
They need to send it, yes.
Yeah, exactly. So
Yeah.
if you don't need to invest in scale, then you have more flexibility. Look for the niche players at diamonds in the rough that might have a better shot at outperforming than these huge private equity funds that are essentially becoming index funds because those are so
Over
big.
time, they all become index funds.
Yeah, I mean they're so large and they're so undifferentiated amongst each other. If you look at the top 10 mega funds, they'll
Mhm.
all talk about different ways they approach the business. But if you look at actually the sectors they invest in, the type of deals they do, many of which they share, they're just not so different from each other. They're all very smart people. They're all very good at doing deals. but they're not very differentiated. So what we look for is something that's a little bit more niche oriented and just different, where we think, yeah, this could outperform, and our size gives us the luxury to do that. If we were 10 times the size, I'm not sure we could.
I really like the way you frame it, because as much as we think about VC firms and the fund size constraining what they can do because they have to deploy so much more, same for endowment, where if the fund size is so big, you need to make different choices about where you allocate and to what type of VCs or private equity you invest. Now, there's something you said which I really like. You said your job in a way is to pick the best managers, and you even said the diamonds in the rough. Can you share how you think about picking these best managers? Because that's an art more than a science, I believe.
Yes, it is. So a lot of it is track record, obviously. So you want to back people who have consistent track record, but I will tell you, those are few and far between. In my course, every time I talk about a case, I put up the track record of the protagonist private equity firm, and rarely do they show, and I'm talking about the biggest names out there, rarely do they show consistent top quartile, even top half performance. It bounces around a lot. This is less true of venture, but I think it's really true of private equity. So track record, of course, is important, but it's not going to give you all the information. So what I look for is evidence that the organization, the firm, is a well-run firm with high employee morale, which I assess mostly through turnover. So when you see a lot of turnover, and we always get an analysis of turnover for all the firms that we look at, when you see a lot of turnover, then you have to interrogate each turnover to see whether it was a person leaving because they didn't like the firm, which would be bad, or a person leaving for performance reasons, which is understandable. So I want firms that are very stable. I want to be able to attribute whatever track record they have to people who are still active in the firm. So often you get presented with a very good track record, but the people who generated it are now gone or have moved to such a senior position, they're not that active in the deal-making process. So there's a lot of attribution analysis that goes into it. So attributing to deals to specific partners and quantifying the track record by specific partner. And the point of that is not to advise the firm who they should fire or not fire. The point of it is to make sure that the partners that are generating the good deals, that they're happy and active, and that they're getting a fair share of the economics. Otherwise, it's unsustainable. Otherwise, you're going to lose the people who are really driving the ship. Also, if there's 20 partners and the track record is concentrated in 3, that's very bad. So I'd like to see that as many of these partners contributing to the good track record, because that makes me feel like the franchise is a durable franchise. It's a real franchise. It's not just a bunch of people independently doing deals, but it's a real franchise. Then there's the attribution of track record to source of value creation, where we break down the profit into how much came from growth, how much came from deleveraging, and how much came from multiple expansion or contraction. And the more of that you show comes from growth rather than things that are largely out of the control of the investor, the better. So if I see a track record that's 2 track records that are equal, and one of them, 80% of it comes from growth and the other 80% from multiple expansion, then I ask myself, well, what's to say there's going to continue being multiple expansion, which is largely determined by the stock market? So I discount that, and I put a lot of weight on the evidence that these people actually had an impact on the companies they invested in. So a lot of splitting up that track record so as to do attribution analysis. The other thing I look at is that the track record was generated by a small number of deals or by a large number of deals. So the less concentration in good deals, the better. Even if that means that all your deals were 2 to 3 times instead of having a bunch of 20-time deals. It's just a lot less risky when you consider backing a fund that has consistency as opposed to a lot of misses and a few huge home runs. You can never anticipate or predict that they're going to have another huge home run in the future.
Now, if I can challenge a little bit, the way you describe it sounds more like a diamond than a diamond in the rough. So how do you identify the diamond in the rough? They don't quite have the track record, they don't have all of it, but you could sense they could become that diamond.
Yeah, you're right. I kind of veered off into talking about the process that we go through to evaluate managers in general. I guess by diamond in the rough, what I mean to say is not just do what everybody else is doing, not just back the next mega fund that's raising money. Consider small managers with a niche strategy and where perhaps they have less of a track record because it's a niche strategy, but where the strategy seems quite differentiated and unique. Um, Also consider new funds, but then I think you have to make sure that the partners in the new fund have their own individual track records. And then the risk that you're taking is that they can coalesce as a group. But again, you can find value by doing that. So, I don't want to exaggerate this diamond in the rough idea because it's hard to find something that doesn't have a track record that is going to an area that's so new as to be speculative and develop the conviction to invest endowment money into that, right? Where there's always a bit of a conservative bias. But we do try to stay away from things that are broadly popular. Like, if VC came to us and said, look, good news, we're raising a new fund to chase AI, I'd say, well, I mean, how many of you are there out there, chasing the same thing? So that wouldn't be very compelling. So things like that, just being a bit of a contrarian, not just going with a herd, understanding that, having a relatively small fund is a disadvantage in some ways, but it's an advantage in others, and sort of leveraging those advantages.
Well, Gus, I think it's a really good way to end this podcast. Thank you very much for sharing your journey, but also all the insights you collected along the way.
My pleasure. I enjoyed it. Thank you.